Welcome back to Money Talks, Life Listens. My name is Joanne Kaban. I'm a senior wealth advisor, financial planner, and co-founder of Isle Wealth. In today's episode, it's all about the most common tax mistakes and, more importantly, how to avoid them. Today, I'm joined by Raizy Marmorstein, CPA with Cameron Izzard Snell here in Victoria, BC. You know, a little history on Raizy is that she grew up on Salt Spring Island, studied economics at UVic, University of Victoria, and became a CPA in 2017. She's now a specialist in Canadian and U.S. cross-border tax and corporate accounting, and I'm super glad to find her because there's not a lot of people in this field on the island, and more importantly, she's a woman, which is awesome. Fun note, Raizy and I actually didn't meet at a tax seminar or, financial planning. We actually met on the basketball court about a year ago, and we've been teammates ever since, which makes this a bit of a crossover episode. Yeah. Alrighty, so Raizy, thanks so much for being here today. To kick things off, what do you love most about living on Vancouver Island?
Everything. I've lived off and on Victoria. Many times in my life I've moved back and forth, and I always end up coming back to Victoria. It's a city while still having all the nature and isn't too big, easy to get around.
Mm-hmm.
It's a great place to raise a family.
Yeah, it's amazing.
Yeah.
It's a little bit slower paced than Vancouver,
yes,
which is nice.
Previously, yes.
Yeah. And so, what kind of drew you to accounting in the first place?
I kind of did like a lot of people get to accounting. They kind of do a few things, and I had done an events management course, and in it I'd done a couple accounting courses and just really liked them and really liked the problem solving of it, the practicality, and I just kind of ended up there, and every time I did it I found that I was pretty good at it, so I kept going.
You like math?
Yeah. I like problem solving. I like answers.
Yeah. And so what brought you into, I think I just mentioned it, that cross-border is a very niche market. What made you want to specialize in that?
Well, was kind of happenstance. I was interviewing at Cameron Izzard Snell, and they wanted someone with cross-border to train on cross-border and start up and have someone to do that. So they asked if I was interested, and honestly, it was a really good time in my career where I was looking for more of a challenge and new things to learn, and I kind of kept joking where I'm like, oh, it's kind of like being back at the beginning. This is so exciting. I thought I knew so much stuff, and now I don't know anything. So I've been doing that probably for about 6 years now. Wow. And I really love it. There's so much to learn, there's so much to know, and I just love the fact that you just keep learning.
Yeah, that's great. I mean, there's never a dull moment in either of our jobs, so always more to learn. So what do you find like really rewarding about working with clients in this area?
And I wasn't sure if, I wanted to do public practice and all that, which is what I'm in now. And it was actually the client work that kind of has drew me and kept me in is, clients come, and I'm sure you see this all the time. They're so overwhelmed and so confused and don't know what to do. And they can come to you and you can be like, hey, we're going to help you. We're going to make this easier. We're going to make this all work out. It'll probably take a little bit of back and forth with us, but we will take the brunt of the work, and just making that really kind of, for many people, kind of scary experience a smooth and easy one.
Yeah, I think that's huge. I think dealing with taxes to begin with is quite daunting.
Yes.
And then adding in the IRS into that.
Yes.
Holy, there's a lot of fear there for a lot of people, right?
Yes. Across border, I got that kind of the doubling of that of people who are extra worried about, how much there's to do, and the IRS can be quite punitive.
Yes.
So, it's very important to get it right.
Exactly. So now that we know a little bit about your background, you started off at Salt Spring, you're now over as a CPA here in Victoria. I thought we should maybe get into what most people are here for, which is taxes. So let's start with Americans who are moving to Canada.
Okay. Yeah.
So what's the very first things Americans should know about taxes when they're moving to Canada? And I know you've talked about your family, they live down south, and this is a common concern.
Yes. I have gone to them, and I'm like, before you come up and move, talk to me.
Right.
And that is the number one piece of advice that I will give people. Yeah. Do not do this move and do not start it in action until you consult professionals. So a professional accountant who has cross-border experience.
Yes.
That's probably more likely found in Canada. I don't know of that many in the United States that do that. We, of course, do it a lot because of how the tax residency works, and which we can talk about. Consult a broker that knows their cross-border experience and can help you move the money and move the investments as needed, and a lawyer as well. And that is honestly the number one piece of advice. That's why I'm telling my family, I'm like, talk to me, don't do anything, because there's so many little traps.
Yes.
In there, there's nothing you can do it. You can just move it, but then you're going to be fixing things, or things are going to be a lot more difficult than they needed to be.
Yeah.
And if you kind of look at it and make the plan before you actually move, then you're going to just be in a much better space.
Yeah, it takes a team.
Yes.
It really does, right?
Yes.
And that's why I'm so grateful that, we have each other, because it's one of those things where we know kind of our areas of where we specialize in, and it's so much easier to work with different professionals and be able to say, okay, we're all here for you. Let's talk it through and make sure we get it right the first time instead of trying to backtrack, because it's very challenging.
So, it might feel like an upfront cost, but I can promise you to look at it before you go. You're going to save a lot of money from trying to fix the it isn't even, you can't break anything per se, but you can definitely just make things way more complicated than they needed to be.
Yeah, that's for sure. So you mentioned that working with a team is pretty much the first step, finding that person that you can talk to. What are some other areas to consider?
So when you're talking to them, hopefully these are the things that come out if they know what they're doing. But a big thing we find with people moving from the US to Canada is that they have irrevocable trusts.
Yeah.
And often they don't even think of themselves as having a revocable trust. They're a very common tool used in the United States. They don't really change anything for you in the United States, but you come here in Canada, they're going to be a pain. We almost always want them closed before you come. If there's a reason that you really need it, then that is to discuss with accountants and the lawyers. But generally, we like those things closed. Similar thing with an LLCs.
Okay.
So, and again, sometimes people don't even think of themselves as having it because the income is kind of a flow-through income. So knowing your structures, knowing what entities you're actually owning is very important when you're making the move, because otherwise you could just be causing yourself a lot of headaches, which we do see quite frequently.
So what headaches would that look like? So we mentioned the revocable trust. So let's just say I was one of those people who, I was living in California. I came over to, Victoria, fell in love with it here, like many of us do. And I had a revocable trust and I didn't close it.
So now you need to do trust returns in Canada.
Okay.
Because if you are, the trustee is now a Canadian tax resident, now you have to do trust returns. And that is a pain. The income flows through. It doesn't even end up in the trust, but it's just a whole other filing, which costs money.
Okay, makes sense. So keep it simple.
Yeah, and generally there's not much of a reason to have it. Of course, if there is a reason, then you can weigh the benefits and costs, but otherwise, just get rid of it.
Makes sense. Okay. And so are there any other tips and tricks or things that stand out to you when people move across?
So a couple things that people, I find, just come over and are a bit confused about. Big thing is Canadians do not have joint tax returns. Yeah. We do them all individually. Sometimes there are shared credits and things between spouses and children that things can be moved around, but they are their own tax returns. In the United States, of course, a lot of people do them. The spouses can do their joint, so that's always a bit of a mind shift to think about. And it does mean, you've been kind of just throwing all your income onto the return in the United States. Doesn't really matter whose investment income is who necessarily. Right. So when you come to Canada, there's things that you can think about as far as making sure the investment income, if it's split, is in joint names and things like that.
Yeah, one of the common things that I have come across my desk all the time is clients who have different types of retirement accounts, right, in the States when they move up here. And so they might have a 401k through work, and they'll have an IRA, and some spouses, will have an investment account like they do with their name on it, some with the other spouse's name. And we always assume that income splitting rules are going to apply in Canada, right? That, they're going to retire, they're going to be able to split all the account income, but that's not always necessarily the case, right? So we need to be really careful on, understanding that before we start changing accounts when you move up to Canada.
Yeah. So, I mean, investment accounts are often easier to change. In Canada, we have attribution rules. So if you change it once you're in Canada, then those attribution rules are going to come into play. So changing it, this is one of those things that if you plan it beforehand, you're going to could be better off.
Right.
For the pensions and things, there's different rules depending on there is pension splitting available between spouses. It depends on how the income is distributed through the retirement accounts. So those are just things to definitely talk about and think about.
So in a nutshell, talk to a tax specialist. There's my plug. Okay. So we were just talking a little bit about retirement accounts in the US. And so I often get asked by clients, I'm moving up to Canada. Can I still keep my accounts? What happens, with this income? Is there any difference from a tax reporting standpoint? So maybe that's what I'll ask you. Is there anything they need to consider from a reporting standpoint?
From a reporting standpoint, any of your income is going to be taxed. Both if you have moved as an American citizen to Canada or a green card holder, you're going to be taxed in Canada and the United States. And it depends on how it is. And the pension income will be sourced to the US, but you do have to report it in Canada still. Okay. So it will actually be treated pretty much the same. An important note is that your Roth IRA, you cannot make any contributions when you move to the United States or when you move to Canada from the United States. The second that have moved to Canada, do not make any more Roth contributions. This is because Canada allows it to be held as tax deferred as well as the other accounts.
Right.
That is in the tax treaty. That is why it is allowed. And that's a 401k. That's an IRA and Roth IRAs. They all get this tax deferred treatment, but the Roth IRA is treated like is kind of like a TFSA
right
here, and so you are not allowed to make contributions because you are no longer a U.S. tax resident, and you're now a Canadian tax resident, so they don't allow you to make those contributions. And if you do, you'll lose your tax deferred status. You also need to make an election. It's due the same day your first Canadian return is due.
Okay.
To say, we want this to get only for Roth IRAs, the only one you have to make an election for, and you just have to say, I want this election so it can get this tax deferred status. There's kind of a form you can do, and I would get a tax specialist to help you with that.
And that's what accountants do, right?
Yes,
Just to be clear.
Yeah. Unless you really love filling out forms and sending things in, come to us.
Perfect. And I heard you say something when you were talking just there about a tax treaty, and so I thought maybe you could elaborate a little bit on that.
Sure. Yeah. Well, I mean, a really important point, and I think one that we haven't made yet, is that as an American, this isn't the tax treaty, but this is American law, is that if you're an American citizen or American green card holder, you are still taxed no matter where you move.
Right.
This is not the usual. Most countries do not go by these rules. Canada does not. Once you leave Canada, you are no longer, if you're not living in Canada, you are generally not taxed in Canada on your worldwide income. You might only be taxed on Canadian income, like rental property or a business.
Like pensions or something.
Yeah, exactly. So in the United States, this is why it's kind of a whole industry, because you need people that know how to file both and use the tax treaty. So the tax treaty, the idea of it is to not have double taxation. So that you're not getting taxed in both countries. Now, does it work perfectly? No. Things also change in the laws, and then they're not caught up in the tax treaty. But in general, the idea is you can get a foreign tax credit. So if you have U.S. pension income, the income in Canada, the taxes that you've paid for it in the United States, you get a foreign tax credit for it in Canada, is the main idea, and goes back and forth. And different types of income have different types of sourcing rules. So for instance, interest is based off of where you live.
Right.
And dividends are based off of where the stock is from. So there's all these tiny little things to know, which is why we kind of are like, for most people, they want to get some extra help with that kind of stuff.
Yeah, exactly. And so with that, Can Americans, use an RSP and tax-free savings account once they're on Canadian soil?
So that's a great question. And one that actually, I guess, is, something we see happen is TFSAs, all of them can be used, but we always recommend to not open a TFSA. A lot of people want to. It has a lot of great benefits, but it is still taxable in the United States. It is not in the tax treaty, and it isn't like, they have the, as we said, the Roth IRA has a special election Canada. It doesn't go back that way. It's probably partly just because the TFSA is kind of a newer vehicle, not anymore, but since the things have been updated, something like that is probably the reason. But so we always suggest you don't, because you don't have to pay taxes on in Canada, but you still have to pay taxes on the US. And since you're not getting taxed in Canada, all that is fully taxed in the United States. You lose all benefit. Plus, it's just complicated because there's no slips issued for a tax savings account. So then you have to go through all your statements and find all your income and then put it on the US return. So it's one of those things you can do. It's fine. But if you do it, it's going to cause a lot more complexity in your reporting. And at the end of the day, cost you money in the sense of the work that needs to be done to make that happen.
So like in simple terms, it's really just going to become an accounting tax bill nightmare and just a lot of reporting. So you would need to come to somebody like myself to help them identify all the line items on their statements and figure out all of that. And it's going to end up probably costing you more time and effort and money for paying specialists than it would be to just avoid it altogether.
Yeah, and you don't get a tax deferred status because in the United States, you're still getting taxed on it. So you're not even getting that benefit. Yeah. But with RSPs, those are totally good to use. The big thing I would say, and I've seen it a lot of times actually this year, is that you don't have any, if you haven't lived in Canada before or haven't had enough income in Canada previously, you don't have any RSP contribution room. So I have seen that. They move, they're like, oh, RSPs, their employers doing matching, all these things. So they are putting their RSP. We come to your end and we're like, oh, there's no actual contribution room because you never built any. Sometimes.
Can I jump in here just for a second, just in case people aren't familiar with what an RSP is? So it's a registered retirement savings plan. It's basically what it is for every dollar you put into the account, you get a tax deduction on your income tax return. And so what happens is when you're working and you're reporting income, and you can correct me if I'm wrong here, but you generate contribution room every year, right? And it's generally 18% of your income up to a maximum limit, which you're probably more familiar with off the top of your head than I am. I didn't, pulling that out of the brain.
Or something.
There you go.
Something like that.
Yeah. And so, this is a really great point that is actually intriguing to me, is that when people come, they have no tax history or no income history in Canada, so they have no contribution room. So real important to know if you're signing up for those employer group benefits that you know that.
And you can build room. It's kind of a complicated the way the dates work and all these things I'm sure that Joanne knows a lot about. But so if you are getting it as part of your compensation package, it doesn't mean you need to necessarily say no to it.
Right.
It's just probably good to talk to someone so you know kind of what it entails. That's what I would kind of say for RSPs. As well as one other thing to consider is that, and this is not just US people, is that sometimes if you also work at a place with a pension, that cuts into your RSP contribution room. So you might not even end up having any RSP contribution room. So these are just things you want to think about and make sure that you talk to your professionals about.
Yeah. And that's another term for that is pension adjustment, I think, right? Because I see, this is something that I help clients calculate all the time, and usually end up going to someone like yourself for help, and we'll say, okay, we'll get out our calculators and, and I start figuring it all out for you. So that would be the pension adjustment. And we want to make sure that you do, that's a really great point, factor that in, because I've had it a few times where clients have over contributed because they forgot to factor in that work pension plan. So really great point. Really appreciate that. So we've talked a little bit about the Registered Retirement Savings Plan, RRSP, and the tax-free savings account. And for those of you who might not know what the tax-free savings account is, it's a tax-free account that Canadian residents get contribution room every year, depending on the amount of years they lived in Canada, right? So I often view this as the one of the best gifts we get from the government. They love to take our taxes. And so we can make as much money in these accounts as possible without paying any tax. In most scenarios, okay? So I'm going to go with the average person. Yes. And right now, the contribution limit for 2025 is $102,000 if you're eligible for the entire contribution room. Now, I want to talk a little bit about RESPs, or the Registered Education Savings Plans. These are often the plans that we set up for our kids to save for post-secondary education, and we put some money in. The government will give us some grant money back. Is there a certain program within the U.S. That is similar, and how would that be treated from a taxation standpoint when Americans move to Canada?
Sure. So the similar program is the 529 plans, which I'm sure most Americans know about. Yeah. They probably know more about it than I do. But what I do know about them is when you move to Canada, you are actually taxed for the income that occurs in them. Something we haven't mentioned yet is when you move from the U.S. to Canada, you get what we kind of call a bump up. So all your assets are at fair market value. So everything in the RESP will now be at their fair market value. So let's say you do sell it a couple of years later for your child to go to university, you might not be paying that much of a capital gain on it. And, and then you do have to pay on interest and dividends. It's also the same the way back. If you do open up an RESP as a U.S. person, you do need to report any income that occurs in there on your U.S. return. We generally recommend people not to open up RESPs after they move to Canada. It just adds a complicating factor, and they don't really get much of the tax or any of the tax benefits. But often people do move with 529 plans. It isn't like they've been planning to move here necessarily. They've opened one, and we see that all the time. Don't close it. Use it how you normally would, and just be aware that there might be some extra taxes you have to pay. But again, you do get the bump up when you move to Canada. So I don't often see it being a huge tax issue. Sometimes a bit annoying to get the reporting we need, but we make it work.
So just to clarify, because I find this really interesting, is that we have the 529 education plan, and you mentioned bump up and fair market value. Mm-hmm. So let's just say, for example, I have $50,000 saved for my son's education in the 529 plan. Maybe I only put in $40,000, it grew to $50,000. So when I move across, are you saying that it's kind of like crystallized at $50,000, that I'm not going to have to pay tax on the difference? So yep. I don't have to worry about that $10,000 gain. Canada CRA is viewing this as it's a $50,000.
Exactly. Yeah.
Awesome.
Yeah. And that isn't just for RESPs. It's for all your investment accounts. Now, again, it does kind of create some ideas of maybe you'll still have those gains in the US, and you'll have two separate cost bases. This is actually can be a pretty complicating factor. Things that you can do to make it less complicated is you could crystallize those gains in the U.S., take an unrealized gain, bump up that cost base, and have it matching in Canada. I know that Raymond James is, I think, one of the only brokerages that actually can track both cost bases and give you reports and cost bases and make it actually not that difficult. So if you don't want to do that, we often do say, Raymond James is a really good option for that because they have some of the best
reporting.
Reporting for cross-border.
Okay, so now that we're talking about reporting, I thought we would talk a little bit about mutual funds and holding different types of securities in different accounts. Especially, I think you mentioned this early on, it matters the geography of where these stocks originate, right? Do you want to talk a little bit about that and how that applies to Americans who now live on Canadian soil?
Sure. Yeah, and this is something where this is why we often suggest, if you're cross-border, you're a U.S. person in Canada, use a brokerage that understands this, because we see it so often where clients are buying these PFICs and you end up, this is a U.S. rule, and it's foreign owned, but in this case, we'll talk about Canadian owned because that's going to be the ones you're most likely in these instances of Canadian US people that we're going to see. So if you have Canadian mutual funds, Canadian ETFs, some REITs, a lot of REITs, but not every single one, just because there's a percentage of passive income is Canadian passive income, they will be punitive in their taxation system in the United States. When you sell them, they'll give you an extra high rate on the capital gain. They tax it yearly as well at a higher rate. So we often suggest not to hold them. That's the simplest. Now, some brokers really like them. There's reasons for there are elections you can do, but the important thing is you need to do the election the year you purchased it. You can't. Yeah.
Okay.
Yeah, you cannot. If you bought it the year before, didn't do the election, the next year you have a cross-border accountant that notices it and says, "Hey, do you have a PFIC?" And they go, "Yeah, I have this Canadian mutual fund." There's nothing we can do. At that point, usually we'd be like, sell it now before it has too high gains and get rid of it. But if you are able to notice it, these are usually on T3s, is how we usually figure out that there is a PFIC. That is how they are reported in Canada on a T3 slip. Not all T3 income is necessarily a PFIC, but a lot are. And so there are two different kinds of elections. One is pretty complex to do.
Okay.
And one is actually a fairly simple one, but it's called a QEF election. The only issue is we need a certain printout document from the stock, from, is it BlackRock or whoever holds it? They need to issue the certain document that tells you the income for the year. And so you can only do it with certain kind of funds because not all funds issue this.
Right.
So you really have to have someone that knows what they're doing when they're picking these funds, and so that they're not causing all these extra issues. We kind of, try to say, let's just not hold Canadian mutual funds, Canadian ETFs, and these REITs. But if you want to, for whatever reason, let's discuss the best way to do that.
Yeah, and it's probably, I've heard a lot of clients say that they've gotten advice from their accountants, especially if they still hold U.S. accounts, right? So a lot of our clients, we won't put in mutual funds while they're living in Canada in their U.S. accounts, like their IRAs.
Right. Well, it's a U.S. law. So,
yeah.
And I will add, actually, the one place you can hold them is in your RSPs.
Yes.
That the IRS does not come after that. That one is protected. But any of your other, again, if you do have a TFSA, if you are holding Canadian mutual fund in it, let's say, you will have to do all this extra reporting to, because that's the other thing about PFICs is even with each of these things, there's extra reporting. You have to report these funds and their fair market value and the quantity and all these things every single year to the IRS. And these are not something that, a report that brokerages come out with because it's a U.S. reporting thing, or Canadian brokerages come out with. So I would say on the U.S. side, I never really see them buying Canadian. I don't even think they can't buy Canadian mutual funds. So this is an issue of, any of the brokerages in Canada who will help them, or if you're doing trading yourself.
Exactly. And so just to clarify on the whole PFIC thing, just to simplify it for someone like myself, essentially it's going to be kind of like what we were talking about with the tax-free savings. A lot extra reporting, a lot of extra work, potentially more taxes. Would you say that, right? Because they're going to charge you more. They're not viewing the investment the same way.
If you get the election, they will not. Yeah. So with the election, it's okay, but that is a bunch of extra reporting. So
and how do they do the election? Because that's not something I'm usually doing with my clients. No. They have to know to do that and go and do that with an accountant. Is that how that works?
It's done on the U.S. return as part of your U.S. return. So you have to make sure you have, I don't know how many, let's say a U.S. accountant in the U.S. It might not be even something they're used to looking for because their clients don't have or all have, their brokerages in the U.S. and aren't going to have this issue. But in Canada, we, as Canadian cross-border people, we see it all the time.
Exactly. Okay, good. So thanks for clarifying that for me. And then there's also a report called the FBAR. My clients love that. It's the favorite time of year. It's time for FBAR reporting. I get tons of emails from accountants. Can we talk a little bit about that?
Yeah. So, we do FBARs all the time. They're an informational return. And, if you are a US person and you live in Canada, if you have more than $10,000 US dollars at any time in the year combined in all these accounts and all your like bank accounts and RSP and TFSA and all these types of accounts, then you have to report an FBAR. So there's not that many people that live in Canada and don't at some point have that much in all of their accounts. So we kind of expect to do them with almost every single return. Sometimes if it's, a very young person return or I've just started school or something like that, we don't see it, but I'd say we see it, 99% of the time. So, and these reports kind of depend on what you have and how they're reported. So anything that is not any account that's not US, so Canadian, or if you have a bank account in the UK, all these things need to go on this report. You need to put the maximum value. It's translated into US dollars based on a treasury rate, which, for us, we give out a spreadsheet that people can just put it all in Canadian dollars and we'll translate it for you and get it on the FBAR for you. And, the FBAR is important requirement. And in Canada, we have something similar, which is the T1135. And a big difference is that the limit to have to report is $100,000. So it's pretty different than the $10,000 in the US. So we don't see it as much. And of course, we do see it. Something that can make it complicated, again, is if you hold stocks in the US, in a US brokerage, you have to report each of those stocks on this form. If you hold them, let's say with Raymond James, they can issue a report where you can kind of put one line for each country. You have one for let's say all the stocks you own in the United States, all the countries, the stocks you own in Sweden, all this, and on and on. Yeah. And it's so much simpler. I will say, if you move to the United States and you have these, let's say you're holding in Charles Schwab, number one, first, all those stocks get a bump up. So now their cost base, you're reporting their cost base is higher than what it says on the reports that Charles Schwab's issues. So that needs to be tracked. And then when you're making purchases and sales, the cost base changes, and that all needs to be reported on T1135, the highest cost base and the year-end, the highest cost base of the year and the year-end cost base of the year, as well as capital gains and income. So if you have a lot of stocks in another country, in the United States, or in another country, or held in a brokerage of another country, it can be a lot of work on this T1135. And that is something we definitely spend a lot of time doing.
Yeah.
For clients and helping them manage that. Sometimes, it makes them want to sell it. Some people want to continue holding them in US brokerages for different reasons. If you are thinking of not holding it, not wanting to hold it, again, this is something that if you do it before you move all those items before you move rather than 3 months after you move, which is something we see quite frequently, you're going to save a whole lot of T1135 reporting, and that will be nice for everyone involved. I will tell you that.
Yeah, and I can tell you right now that a lot of the times for people who move, so let's say you're with Wells Fargo, you're with Charles Schwab, and you move to Canada, as soon as you're in Canada, it can be really hard unless you're working with another broker on Canadian soil that's cross-border to make changes. It can be very difficult because they're not dually licensed. And it's like you mentioned at the beginning, it's harder to find people in the US that are dually licensed.
Yeah, and that understand the Canadian tax issues, right? They'll start a revocable trust, they'll do different things, and they don't actually have an idea that this could be an issue. So having that cross-border experience really can make a very big difference in the ease of all your reporting.
Okay, so we've covered a lot of different things for those Americans moving to Canada. So in a nutshell, what I'm hearing here is you need help, right? This is a lot to take on.
Yeah, I have trouble figuring out what level would be of like simplicity of your income that you wouldn't need some sort of help. Like, I really think there's so many different, as we said, like traps and things that even if you've done it always by yourself, maybe all your income is only sourced from one country, is all wages in Canada that year, it's probably good just to talk to somebody just to make sure you're not missing out. But most people, having this help to make that transition will make it a lot smoother.
Mm-hmm. So I got one final scenario and then we can close off maybe this section, is I have a lot of American citizens who were maybe born in the States. They moved to Canada and they're like, I was a child. I didn't really, I never worked there. They're kind of flying under the radar as a dual citizen here in Canada. And so they've never filed a U.S. tax return. And as far as I know, you are required as an American citizen to always file a U.S. tax return, from just being a citizen or, like you mentioned, a green card holder. So is there a way for clients or these types of individuals to get caught up on their tax returns later in life when they found out, whoops, I have not been filing all these years and I'm technically supposed to? Like, what do you do there?
Yep. There's actually 2 programs that the U.S. has. Of course, this is a big issue. Because sometimes, people don't even think about it. They never even maybe lived in the United States. And so there's 2 options. There's the first one's called a streamline, which is you go back 3 years of returns and 6 years of FBARs, 3 years of U.S. returns and 6 years of FBARs. And then, we've never seen them charge or penalize. If you put it through there, they won't charge you because an FBAR, the penalty for not filing FBARs is $10,000 per year and arguably per account. They have done it before where, you have 6 accounts, that's $60,000. They have, that's, I believe it depends on who's doing it, and they have charged that to people before. Other people have been like, really, it should just be $10,000 for the form, leave it. So it's a big punitive penalty. Again, we've done tons of streamlines and I've never seen anyone get charged this. The idea is that they want you to get caught up, and then from then on, you should be filing returns as normal on time. There is one more, an option that's a newer one, so not as many people may have heard of it. So I'm sure everyone's heard about a U.S. streamline. It's a 5-year program, and at the end, you renounce.
Hi, this is Raizy. Earlier when I was speaking to Joanne, I had mentioned this 5-year program as an option for citizens who are U.S. citizens who want to play catch up. And I just wanted a chance just to clarify these details so it's very, very clear. The name is the Relief Procedures for Certain Citizens. And how it works is that you first renounce your citizenship. So it's only good for people who want to or are willing to give up their citizenship. So you end up going back 5 years before the year you've renounced and do filings for then, plus the year that you renounce, you have to file for that. So it ends up being 6 years of returns. There's a few eligibility requirements. Kind of the main ones are that you're only supposed to have about $25,000, or you can only have up to $25,000 of tax owing over those 6 years of filings, as well as your income has to be under a certain amount. In 2024, it was about $200,000. This is in US dollars, of course. So if you meet those eligibility requirements and a few others that, you would definitely want to go and look up first, and you're interested in doing it, the step would be to first renounce your citizenship, and then you can do these filings. A nice thing about it is even if you do owe some taxes, as long as it's under the $25,000 and you can do it, is actually none of that tax will be payable. You actually get it free. So it's a nice part of the program. Let's say you do have a year where you do owe $1,000 or, $100. None of that will actually be payable. So that's a big benefit of this program.
As always, we just need to talk with a specialist in this area.
But if you are behind, you can get caught up. It's the IRS will generally not penalize you to do this. So say do it.
We've talked a lot about many different traps, many complexities when it comes to Americans moving to Canada. What are the 3 common mistakes that you see come across your desk on a regular basis that we should have our listeners know about?
Yeah, I would say, as no surprise, I think I've been saying this over and over again, is taking action before getting the professional advice. Get the professional advice before action. You'll be in a much better spot. It's the number one thing we see. We see it a lot, I would say, because, people move here, then they find the cross-border accountant, and then we start talking and things come up. The number two, I would say, is people not understanding what entities their businesses or their individual holdings are held in. So again, revocable trusts, LLCs. So often people don't seem to understand that these, because again, in the United States, they're often don't really mean that much. They're just kind of another slip. But in Canada, they can really make things more complicated and add a lot of extra reporting. So knowing, really thinking about what you have and doing that. And honestly, I'd say the third one is those PFICs we were just talking about. We do see them a lot, and it's so often, again, by the time they've come to us, maybe they've used another accountant, maybe they used an accountant in the US, an accountant in Canada. Nobody picked it up, and they've come to us, they've held them for a while, and now we're looking at these, potentially large tax bills when they sell them, and we're trying to figure out the best way forward.
We chatted a lot about Americans moving to Canada and how important it is to work with professionals such as Raizy and myself. But what does it look like the other way around when Canadians decide to move to California for warmer weather or to maybe go there for work? We're going to talk a little bit about being a snowbird and how being a dual residence, American, Canadian citizen, how does that all impact your tax situation? So we'll see you in the next episode. Thanks so much for coming, Raizy. Super appreciate it. Looking forward to the next episode.
Thanks.